Financial Management and Corporate Finance, Revised Study Guide, Course Code, BMB 204, Max Marks 100. Section A, Short Answer Type Questions, 2 marks each. Note: in the actual exam, you must answer all 10 questions. This section contains detailed explanations for 10 high-frequency conceptual questions. Q1. Differentiate between profit maximization and wealth maximization. Easy explanation. This question asks you to compare the 2 main goals a finance manager can pursue. Profit maximization, the old goal. This is a traditional, short-sighted approach that focuses only on making the biggest profit, net income, right now. Problem: it ignores crucial factors like risk. A risky project might offer high profit but could fail, and the time value of money. A rupee received today is worth more than a rupee received next year. Wealth maximization, the modern goal. This is the superior long-term approach. It aims to increase the net present value, NPV, and ultimately, the market price of the company's shares. Advantage: it considers both risk, by using a suitable discount rate, and the time value of money. By maximizing shareholder wealth, the firm takes a sustainable, stakeholder-friendly view. Q2. Define the cost of capital. Easy explanation. The cost of capital is essentially the hurdle rate, or the minimum return a company must earn from any investment project to keep its shareholders and creditors happy. Definition: it is the minimum rate of return a firm must earn on its investments to ensure the market value of its equity shares does not fall. Application: it is used as the discount rate when evaluating whether a new project, like buying new machinery, is financially viable. Composition: it's not just one number, it's the weighted average cost of capital, WACC, which is a blend, average, of the cost of all the money the company uses, equity, debt, and preference shares. Q3. What is a cash budget? Easy explanation. A cash budget is simply a forecast, like a weather report, but for a company's cash flow. Purpose: it's a financial statement that estimates all the cash the firm expects to receive, inflows, and all the cash it expects to pay out, outflows, over a specific future period, e.g., the next 3 months. Benefit to management: it helps management proactively spot 2 key situations. 1. Cash shortages, when outflows exceed inflows, allowing the firm to arrange a loan in advance. 2. Cash surpluses, when inflows exceed outflows, allowing the firm to invest the extra cash and earn interest. Q4. Explain the concept of the operating cycle. Easy explanation. The operating cycle tracks the time it takes for a company's cash to complete a full circuit, from when it's spent to when it comes back as revenue. Process: it starts when cash is used to buy raw materials, moves through production, work in progress, becomes finished goods inventory, is sold on credit, becoming receivables, and finally returns to the company as cash. Calculation: operating cycle days equals inventory conversion period plus receivables collection period. Significance: a shorter operating cycle is better, as it means the company's cash is tied up for less time, improving liquidity and efficiency. Q5. State the assumptions of the Modigliani-Miller hypothesis without taxes. Easy explanation. The hypothesis is a famous, groundbreaking theory about capital structure. The without taxes version is built on an imaginary, perfect financial world. The original hypothesis, 1958, assumes a perfect world where perfect markets, there are no transaction costs, like brokerage fees, and all investors have free access to the same information. No taxes. There are 0 corporate or personal taxes. This is the core without taxes assumption. Fixed investment policy. The company's decisions on which projects to invest in are already set and won't change based on how the projects are financed. Equal borrowing/lending. Individual investors can borrow or lend money in the market at the exact same risk-free rate as the firm can. Q6. Define capital budgeting. Easy explanation. Capital budgeting is the process a company uses to decide whether to invest in long-term projects like buying new machinery, expanding a factory, or developing a new product. Focus: it involves planning and managing a firm's long-term assets. Goal: to maximize the firm's value by selecting those projects whose benefits outweigh their costs, i.e., projects with a positive net present value. Q7. What is the difference between a fixed budget and a flexible budget? Easy explanation. Both are planning tools, but they differ in how they handle changes in activity levels. Fixed budget: a budget prepared for only one specific level of activity or volume. E.g., planning costs for exactly 10,000 units. It becomes useless if the actual output is different. Flexible budget: a budget prepared to show expected costs at various levels of activity, e.g., showing costs for 8,000, 10,000, and 12,000 units. This is far more useful for performance evaluation because it adjusts for actual output. Q8. What is the cash conversion cycle, CCC? Easy explanation. The CCC is a refinement of the operating cycle that measures how long a firm's cash is actually tied up in operations, factoring in credit received from suppliers. Calculation. It adjusts the operating cycle by subtracting the time the firm takes to pay its own suppliers, payables deferral period. CCC equals operating cycle, payables deferral period. Significance. It is the true measure of a firm's working capital efficiency. Q9. What is financial leverage? Easy explanation. Financial leverage is the use of debt, fixed cost funds, to increase the potential returns for equity shareholders. Mechanism. Since interest payments on debt are fixed, if the company's operating profit, EBIT, increases, the profit per share, EPS, will increase at an even faster rate. Risk. It works both ways. If EBIT falls, the burden of fixed interest costs remains, causing EPS to fall much more rapidly. Q10. Define EBIT and its significance. Easy explanation. EBIT stands for earnings before interest and taxes. It is a company's operating profit before accounting for how the firm is financed, interest, or its tax obligations. Significance. It measures the profitability of the company's core operations, independent of its capital structure, how much debt it uses, and the tax laws. It is a key input for calculating both operating and financial leverage.